Yeah.
What matters is your lifetime tax efficiency, meaning what is your effective tax rate today, meaning the blend of your marginal rates versus your effective tax rate in the future. If you believe you're going to have a higher effective tax rate in the future, Roth makes sense today.
Financial independence,
freedom,
financial picture,
independent financially,
financial future,
financial freedom and wealth,
financial independence.
Get your fill, financial independence and long life. Welcome to another episode of Get Your Fill, Financial Independence and Long Life, which is what we all want, which is why I'm very happy that we have TJ Van Gerven. TJ is a financial advisor and planner. He's the founder of Modern Wealth Builders, and he's the host of the podcast, Do More With Your Money. After graduating from Virginia Tech, TJ has spent his entire career in the financial service industry. TJ is passionate about helping millennials use money intentionally as a tool to build toward financial flexibility and independence, which is what we all want, right? TJ,
Absolutely.
thanks for being with us.
Thank you so much for having me on today. I really appreciate it. I'm looking forward to speaking with you about all those things.
Awesome. And I think we can, some of the things that we were talking about ahead of time, I think we can make that into a really nice kind of conversation to help people who are just like getting out of college. They've got student loan debt. They don't know, should I be paying that off? Should I be saving for a house? Should I be just renting until I'm 45? Should I live with my parents as long as they'll have me? I mean, what kind of things? I mean, I've worked with, I'm a real estate broker, and I have worked with clients who have, $500,000 in student loan debt. I mean, I don't know. I mean, I don't want to go down the student loan avenue if you don't want to, but I just feel like that is a question. I actually talked to somebody yesterday. She's in her early 60s. She went back to school late in life. She still has student loan debt, and she's wondering, right? Should I pay that off? Should I just hope I die before it needs to be paid? What are your thoughts about saving versus paying off old debt?
Yeah, no, it's a great question, and it's definitely a big topic, for millennials in particular, just because they tend to have the student loan debt. Obviously, if you have student loan debt that late in life, that's obviously its own issue as well. I would say it's really difficult out there. I'll just start with that. And I think hopefully people can make an informed decision before they take out student loan debt and really think about the return on investment there. Because I do think that in many different, studies, it's the return on investment isn't there. And so just make sure that if you have that foresight to really think through and have a plan as far as what is your career path there. Because I think a lot of times, younger people will make a decision and then they'll realize this isn't actually what I want to do, and they'll switch. And then it's really a sunk cost and a total, 100% loss in that case. So I would say, obviously planning ahead is always the first step. Now, if you do have student loan debt, right, we're already past that point. I mean, the first thing is just awareness, right? I think a lot of people don't even understand kind of their repayment structure. They don't understand their interest rates. So the first step is understanding what are you required to pay back? How much interest are you paying? Then you can start to really determine what is the best use of your money, your excess cash flow. So how much extra you have coming each month.
Yeah.
Is it worthwhile to pay that down at an accelerated rate? Or should you be doing other things like building a cash reserve, maybe investing a little bit if you have a 401k, maybe at least getting your 401k match? Are there some free money options out there for you before you put all of your money towards debt repayment?
Yeah, and it's difficult, right? Because you've got the magic of compounding interest, the time value of money. That if you can start saving earlier, then you're going to be in better shape later on. But at the same time, if you're, I don't know, to me, I never had student loan debt because you couldn't have student loans when I was a kid, but that wasn't a thing. But the way I understand it, it's simple interest, right? So every day, your interest is compounding. Is that right? So if 30 days, it's like a penny today and a penny tomorrow. And then at the end of the month, rather than saying, 30 cents at the end of the month, you're getting a penny a day. So it's actually going to be a little bit higher, right? And then it pays the interest first. So you're never necessarily touching the principal.
Yes. So, I think it can depend sometimes on, if it's like a private student loan or a public student loan. But, my understanding it is, more of a simple interest calculation. It's not like an amortization schedule with your mortgage where you're paying primarily interest up front. Like you are paying a, proportion amount of interest. But yeah, if you are only paying that minimum balance or minimum payment, you may not be actually paying down any of that principal on that debt. And so again, that's why it just starts with awareness of like, what are your payment requirements? How much interest are you going to pay over the lifetime of that repayment schedule if you're only making minimum payments? Now, there's a lot more flexibility with, public loans than private loans for like repayment options. Sometimes there's income-based repayment options. But again, this all just starts with awareness. It all starts with understanding your cash flow. How much extra money do you have to really put towards the growth of your net worth? I think as long as you are actively saving and putting it towards growing your net worth, whether that's paying down debt, investing, increasing cash reserve, that's really the fundamental key there, and building those habits early. And then some of the more strategic technical questions come into play.
When you first sit down with somebody, what kinds of things do you talk to them about? What kinds of things do you need to know to help them to make a good decision?
Yeah, that's a great question. And I do tend to work with, a lot of young couples. So sometimes they're, maybe newly married or engaged, and they're transitioning from, having individual type accounts to really having a more of a joint ownership mindset. So, really just educating them on, if you're going to be taxed as a joint unit, let's think through together how you guys can use your joint resources to be as tax efficient as possible, to have a household investment strategy, to think through what are the major risks that can get in the way of your financial plan. So the first thing I really like to do with the client is just understand, I mean, what are their basic needs? Like, what is their most pressing things that are bothering them? Try to alleviate that, number one. But then once we get through that, really get organized. So define what it looks like to have a cash reserve. Define what it looks like to, hit a personal savings rate that's going to set you up for long-term financial success. Define what are the types of accounts that we can contribute to. Are we going to do 401k contributions? Are we going to do Roth IRA, whether backdoor or direct contributions? Are we taking advantage of your health savings account? Do you have a stock purchase plan? Are you trying to save up for a down payment on a home, right? So once we get organized and we kind of automate these things, then we can start to transition into the actual financial planning or like life planning conversations where it's really like, what are we trying to accomplish? What are the trade-offs there? What levers can we pull to accelerate that process for you? And then just quantifying it.
When you first sit down with couples, this is the whole thing because I know a lot of people, this is a real. Do you sit down with them and you find that they have completely different goals and there you're like, oh, I don't do marriage counseling, right? So
Yeah.
how does that do you sort of, because I this happens to me in real estate, right? They're like, oh, I want to fix her upper, and then was like, no way, I don't even want to paint the place. You're like, uh-oh. And sometimes those relationships don't ultimately last, but
Mhm.
how do you help people to get on the same page?
Yeah, that's a great question. I think the nice thing is that working with millennials and younger folks in general, they are a little bit more moldable in their journeys. So I will find that if, I've only, I don't tend to work with retirees, but if they've already had a long relationship, they've already figured out kind of how they're going to do things. And so with younger people, I really just try to educate them on the different options. I'm not here to tell people how to use their money. I tell them what I find works. So, I do find more of a joint mindset does work when managing your finances. Just from a simplification standpoint, having one combined joint checking. Even now, like Fidelity, for example, has like their checking account. You could have all of your money in their money market fund. So, like, it kind of eliminates the need to have all of these extra savings and checkings accounts. Now, sometimes people do want to have their own individual checkings still, which I think is totally cool, right? You want to still have the autonomy to make purchases without maybe your partner knowing, understanding. So it's really about figuring out what works for them. A lot of times they will, default to me because they're open and they're moldable, which is great. And also just really coming to an agreement on a rules-based strategy for how their finances will be managed. Again, I think about things at the household level. So how are all your investment accounts combined going to look like, going to perform over the long term? Because ultimately that's what's going to, dictate your financial success.
Yeah. Do you ever work with entrepreneurs, people who are self-employed?
Yeah, absolutely. So I do a lot of like equity compensation stuff. So sometimes either they might be a founder of a company and they are expecting like a payout situation, or there are some self-employed small business owners where, yeah, they're fully taking advantage of things like solo 401k, or, thinking about S Corp, how much to pay themselves a salary, how much how to, be efficient tax wise, essentially. So there's a couple different variations of it. I will say I do tend to work more on the employee side, especially if you maybe worked as like a startup employee and you go from getting compensated in things like stock options, and then your company either gets acquired or goes public, and now you're having a substantial windfall event.
Yeah. And that is a wonderful thing to happen, right? But if you do it wrong, right? I mean, those kinds of things, if you're in a situation where you're working with someone like yourself and you're making great decisions versus saying, "Oh, okay, well, I'll take half of this and go on a vacation, and then I'll do," or just putting it into something that, "Oh, I'm just going to go buy XYZ stock or something." So, how do you help people to figure out what to do in that sort of situation where they suddenly find themselves with a nice amount of cash that they don't necessarily want to have to, work again. They don't necessarily want to have to do that again, right? So I just made X amount of money. Maybe I could retire. Maybe I could do
Sure.
whatever.
Yeah, it's a great question. And I think it all starts with, again, really being confident and comfortable with the fundamentals. So it all comes back to the same things as far as how much cash reserve do you need? What is your household investment strategy? Yeah, are you in accumulation mode still, or are you going to use your resources? If you're going to take time off from work, maybe you haven't achieved financial independence, or we can talk about what that might look like. But even if you're going to use your money to, let's say, do a sabbatical, what is the appropriate allocation as far as an investment strategy goes? I really think of things at kind of the macro level. So owning the whole stock market index fund type strategy, really educating the client on here is the range of outcomes. Here's what you can expect reasonably from this type of portfolio. And just understanding that how you react in different market environments, your behavior is ultimately going to dictate your long-term investment returns. Um, I try to steer people away from individual stocks. I think that it's totally cool if you want to, but I think again, you just create rules where, hey, we're going to limit your total investable assets 10% or less is going to be individual stocks. Because I just, you can look at the data behind this, but even professional money managers who all they do for a living, groups of CFAs that manage mutual funds, even they underperform. So to think that we're going to make decisions over the long term that's going to beat the overall stock market is highly unlikely.
Yeah, for sure. But there's the emotional component, right? You see, oh, stocks are going down. I've got to get out. I've got to sell, right? Get people. How much do they have to understand in order for them to be good at managing their money and good at accumulating wealth? And
Yeah, that's a great question. I think that, one of hopefully the value adds that I provide to my clients is, there is a layer between them and their investment assets. They don't necessarily have like trading ability on their assets. So if they do want to make changes, we talk about them first. So if there is a scary market environment or, then I could remind them, hey, listen, you're not using your investment assets right now, right? You have another 10, 20 years until you're going to use it. You have a dedicated cash reserve. You're living below your means. Here's your lines of credit. Here's the things you can tap into. So just reiterating like, hey, this is why we create a margin of safety within your financial planning. I kind of like it to take a barbell approach where it's, we're conservative with your planning, but then we're aggressive with your investments. So by being conservative with the planning, it gives you that capacity to take on risk. And I think once people understand that and go through the reps, they get more comfortable.
yeah. Do you find that some people come to you with a nice ambitious plan, like we want to retire by the time we're 45 and blah 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 blah. And then you look at what they're doing and they're spending everything they make. Do you have to do some education to sort of say, hey, you'd be able to do this a lot quicker if you'd stop buying stuff?
Yeah, that's a great point. I mean, I don't want to be a yes person to my clients. So I am there. If something's not realistic, I want to make them aware of that. And it's not too, I mean, I tend to attract, pretty, I would say financially savvy and financially literate clients. And they recognize, that even though they're very smart, that it's good to have a partner that they can have a sounding board and who specializes and does this all day for a living. So I think for the most part, their expectations are usually pretty good, and they're usually pretty good at saving money. I will say that, I tell clients you can have anything but not everything. So a lot of times it's just about figuring out exactly what it is you want. I think the real estate thing sometimes is more of a, you know, unrealistic in some cases when you haven't just given the down payments you need these days, especially I work with a lot of people in Massachusetts and New York, near major cities. And it's even if you're making multiple six-figure income, the amount of down payment you need to get into these properties is a lot.
Yeah, hopefully that's sort of lessening a little bit. The market is softening a little bit, so hopefully people aren't going to have to like practically pay cash for everything if they want to get
Right.
beat out everybody else. We should see a little less bidding wars, hopefully. But yeah.
Exactly.
Well, that's so I have two other sort of questions around that piece, like the role of insurances and the role of real estate in a healthy sort of strategy in your, I mean, I know it's a broad brush. It depends so much on the individual, but do you have some sort of guidelines about that?
For making real estate purchase?
With real estate, and also people have the idea of like you've got to have X amount of life insurance, you've got to have X
Oh,
amount of
sorry.
whatever. So those kinds of questions.
Yeah, absolutely. So I think, a lot of people focus on the accumulation side of financial planning, right? How can I optimize my investments and tax planning too? How can I be tax efficient? Those are all great things.
Yeah.
And we want to make sure we're doing that. But, once we get those in place, we do want to consider the major risks that can get in the way. And what are some of those risks? So, I think the most one that's readily known is, dying. Obviously, like we want to think about what would happen to our partner or what would happen to our children in the event that we were to die. And so, really, what I educate them on in that particular risk is, you haven't achieved financial independence yet. So, until you have a level of net worth or assets where if something were to happen to you that your family would be taken care of, we want to protect you. And the best way to do that, in my opinion, is through term life insurance, which means that you're just going to cover yourself for a term period of time. You see a lot of, permanent life insurance being sold online, which we can talk about, but I'm not a huge fan of that. I think that's very niche, part of the population that actually makes sense for. And so really just educating them on like, here's an amount of term life that will cover you for X amount of years, that if something were to happen to you, the other person would be taken care of. So that's one major risk. I'd say a big risk that a lot of people overlook is long-term disability. You're actually more likely to become disabled than you are to die prematurely. So this is a major risk. If again, you haven't achieved financial independence, your income might be your largest asset. Even if, especially if I work sometimes with like physicians where they go from making like 75,000 to 500,000 and they might have student loan debt and all these things. Their income is their largest asset. If
Right.
something happens to their income, that totally derails their plan. So really understanding what is your group coverage through work. A lot of times group coverages are going to have things like monthly benefit limits. They're not going to have cost of living adjustments. They're going to have limitations on own occupation versus any occupation. So understanding these things doesn't make sense to get third party insurance. Nice thing is, being a fee-only advisor, I don't sell insurance, so I'm really here just to educate you. I don't get compensated on it, and I think people appreciate that.
Yeah.
Other protection planning would be like liability, thinking through just homeowners, auto, umbrella insurance. Those are the main ones.
Yeah. Yeah. And then so how do you help people decide owning versus renting? Like what makes the most sense for them financially?
Yeah. Yeah, that's a great question. And that's definitely a prominent one with my demographic and been having a lot of real estate purchases recently, actually. But I always start with the holding period. So to me, that's the biggest factor is are you confident that you're gonna hold on to this property for long enough to make it worthwhile? Because I think what people don't understand sometimes, again, going back to the debt conversation, is with an amortization schedule in your mortgage, you're primarily paying interest upfront if you look at that schedule. And so if you only stay there for, let's say, 5 years, you might not build much principal into the property. And then if you go to sell the property, you have to pay transaction costs to the realtor. And so you can get in a situation where you actually can lose money, even if the market is going up over that time. And I think contrary to some people's belief, real estate does go down. It's just that it's not traded on an exchange like the stock market, so you don't see it. But really, again, just understanding how does it impact your cash flow, right? Are you comfortable tying yourself to this level of fixed expenses is important. Again, do you think you're going to have that holding period? Those are really the main conversations. As long as those two things are aligned, then I think it's good to go.
Yeah. And of course, depending on your income and the situation, you also do have that right now, at least, you still have that deduction for your interest. So sometimes that can help somebody to make the difference if the rent is the same as the mortgage or whatever. That could be what kicks them over the edge.
That's true. I mean, I think again, so educating them on that, right? Like the standard deduction is, like 12,500 or something per person. So if you're married filing jointly, you're
Yeah.
looking at 25,000. You have to pay a substantial amount of interest for it to increase above that standard deduction. But it is true, it can help the cost of ownership for sure.
Yeah. And I do believe, like I said, that we're coming to a time when prices are not going to keep going up. They're already sort of softening in our area because I'm also in Massachusetts, that
Right.
we are seeing not so much bidding wars, not so much. I mean, of course, there's certain, price ranges and stuff like that, but to the reason that some people don't realize that real estate go down is because it's been going up for like 15 years. So there are
Right.
people who their entire career, their
That's
entire
all I've
investment
seen.
career, real estate's been going up and
What was
doesn't
your experience like during COVID though? I mean, when the unit before, that stimulus kind of came into place, like real estate values were dropping in that period, no?
COVID was like the big, everybody wanted to move someplace else. Almost immediately, prices started to go up because people were like, well, if I'm going to be home all the time and I have to work from home, my kids are home, and now my parents are going to come move in with us so that they can take
Right.
care of the kids because I'm on a Zoom call all day. We need a bigger place. And then other people were like, why should we be living in this little apartment in the city? We can live anywhere. Let's go to the beach. Let's go to the mountains, right? So certain areas, I mean, the prices went up quite a lot. Bigger
Right.
homes in more quieter locations with yards, and everybody got a dog. There were all these different things that happened. So it really depended a lot on the area, but for the most part, prices were going up
Yeah.
at least in the Massachusetts area, and I think that's indicative of a lot of cities. Right? People were in the city in a small place, and they're like, we're either going to move or we're going to kill each other. What should we do?
Yeah. When presented those options, that makes sense. Yeah.
But that was actually 2020 was when we were thinking that things were going to kind of crest. And then all of a sudden they didn't crest because we had this impetus of everybody wanted to live someplace different. So
Right.
yeah, it was kind of strange.
I mean, the real estate one to me, I understand, my dad is like a blue collar guy. He's always like built his houses and he loves real estate because it's a tangible asset, right? Again, you're not bombarded with an exchange and seeing the price go up and down every day. And then for him as well, right? He had the sweat equity component where he could build
Right.
it and create
That's
value there.
huge.
So I totally understand the, you know, reason why people are drawn to real estate. And I think for millennials too, they've seen and heard from their parents as far as like, hey, I bought this house for X amount. It's now worth X amount. And that's all they think about though.
Yeah.
And that is a good return on investment. But again, you have to also think about all the other outside costs, maintenance, property taxes, insurance. Now, obviously, you are recouping you have to live somewhere. So that's a
Yeah.
recoup on your living expense.
Yeah. Yeah, but it is definitely wrong to think of your primary residence as an investment, because if you're just gonna sell that place and go someplace else, right? In most cases, you're not gonna sell your house and say, "Great, now I've got the money." Like, now
Right.
what, right? If it's fine, if you're gonna buy a camper and drive around or whatever, but for the most part, people want to live someplace. So
It's a
for
great
the
point.
majority of their life, they should not be looking at real estate, like their primary home, as an investment.
That's a great point. And I say that same thing to people is like it's really about the standard of living you want. And again, that time horizon. If you're going to be somewhere for a long time, you want to have control over your property. You want security and that, you're not going to have to look for a new place. And obviously, long term, there are financial benefits to owning your property. I mean, now I like to remind people property taxes and insurance, right? You're never going to outlive those things, and those things are going to increase with inflation. So there's always going to be recurring costs there.
Yeah. And that's a great point, because people, I mean, I know people whose homes are paid for and they're still having trouble hanging on to them because now they're on a fixed income, and their property taxes have gone so high that they just can't pay them. I mean, that's happens in certain
Yes.
areas that didn't used to be desirable, and now all of a sudden they are. And they're like, well, my taxes are $12,000 and my Social Security is, $975 a month. So how am I living here, right?
And that is kind of the scary thing about where we're headed a little bit with inflation is that, if you have these fixed income sources, whether it's a pension, which is becoming more and more rare, or Social Security, Social Security is only meant to replicate like less than half of your pre-retirement income. And yes, there's a cost of living adjustment, but your Medicare premiums increase. So there's really not much of a cost of living adjustment there. And you're right, there's some situations. I think in New Jersey, there was like, I've heard of people or towns like signing agreements where they'll get the equity of your home and you don't have to pay property taxes. Like that's how expensive it is.
That's terrible. And that, yeah, and like a reverse mortgage, same type of thing. Like you're
Yes.
basically, you thought you were going to leave this thing to your kids, but unfortunately, you need it to live. So, not necessarily a,
Something to probably try to avoid and
e-
plan ahead around for sure.
exactly. But it's okay if you don't want to answer this, but this question came up the other day about when people, the benefits of like when you should take your Social Security benefits, like as soon as you can, wait till as late as you can. And I figured it out the other day, and I was pretty sure that I did it right, that it was going to take 29 years for the person to recoup that money that they would have lost by not taking it right away. I mean, do you have a thought about that? I know you mostly work with young
Yeah.
people, but
No, I came from more I mean the industry is geared towards retirement planning, so I'm very comfortable in that space. That's where I learned. But I would say, yeah, the whole Social Security conversation, you're correct. It's all about that break point in longevity. So obviously, every year you delay, I believe you're getting an 8% growth on the benefit base there. And so it's really a longevity question as far as how long do you think you're going to live? They have actuarial tables, so they have it priced out, and your 29-year break point is probably where they price it out, where if you die before then, you're better off taking it sooner rather than later. If you live beyond that, let's say you live to age 100, you're much better off delaying the benefit because you're getting an 8% growth on the benefit base. And then over all of those years, it adds up to a substantial amount. So I would say if you have the resources, you have the investable assets, the net worth to hold you over, I would delay
yeah.
personally. But that is not the case for most people.
Yeah. Well, and you probably also look at your family and how long people are living, right? If
Right.
everybody in your family dies at, 70, then hey, get the money while you can, right?
100. It is a personal conversation. If you don't have that longevity in your family history, then yes, absolutely.
Yeah. Yeah, I guess, I mean, again, it's a personal thing, but it's a question that came up the other day. And I said to her, I said, well, what's your family? How do you, I mean, I'm obviously not qualified, but I just said, do
The
the math and figure out
100%.
how long you need to live to make this make sense.
That's a simple conversation right now. The one other thing I'll point out to some people to consider is if you are early retirement years and you have the majority of your retirement assets in tax deferred accounts, so accounts that not Roth accounts, accounts that you're going to owe
Right.
income tax on the distribution. You also should consider Roth conversions if you have the cash to pay it, because if you're delaying Social Security, that's less income you're taking. That's more of your income bracket that you can fill up with a Roth conversion. And why that adds value is that you can pay tax at a lower marginal tax rate, shift it to tax-free bucket. You might live 30 years in retirement, and we also don't know the future of tax rates. That can add a ton of value too. So that could be another reason to delay Social Security.
I'm glad you brought that up, TJ, because I think a lot of people don't understand why Roth is such a great thing. I mean, I love Roth. I just think that they're so smart and but some people are like, well, no, I want to get the tax benefits now. But so you're betting that taxes are going to go down and that you're hoping that you're going to make less money later. And I don't know. Can you just talk about your kind of philosophy about Roth versus a regular IRA or other kinds of investment?
Absolutely. So it is a bit confusing, and I do want to take a balanced approach because I think you can go too much on the side of like, oh, Roth is the best thing ever, or too much on the side of I just want the income tax deduction.
Yeah.
What matters is your lifetime tax efficiency, meaning what is your effective tax rate today, meaning the blend of your marginal rates versus your effective tax rate in the future. If you believe you're going to have a higher effective tax rate in the future, Roth makes sense today. But the thing to understand is, let's say you are younger and you're considering Roth versus traditional 401k contributions. If you're in the same effective tax bracket today as you are in the future, it doesn't matter whether you go traditional or Roth. It's the same exact amount.
So I thought that Roth um, grew. So if I put $1,000 in an IRA, in a Roth IRA, and 50 years from now it's worth 500,000, that whole amount is now not taxable
That's true.
versus so it's the whole growth. Whereas when I am deferring my taxes, if I put $1,000 into a traditional IRA when it's worth 500,000, I'm paying taxes on that 500,000, right? So the growth, I don't know, it feels like there's more taxes being paid that
Let
way.
me take a step back. You're right. So when you put money into the Roth, it's going after tax, meaning you're not getting that income tax deduction. Now, any growth it experiences is tax-free, and you can distribute that tax-free. What I'm saying is that if you include the income tax deduction, which you would get with the pre-tax, and you were to invest that money, it's the exact same if your effective tax rate in the future is the same as it is today.
Okay, so instead of just putting in the 1,000, you should be putting in the 1,000 plus whatever
The
you
savings.
saved in your tax. Okay, excellent. That's the first
Yeah.
time I've heard somebody say that,
Yeah. So that's important to understand. I think there's some confusion around that.
for
And
sure.
then, but the reason why you want to have a blend of the two, and it's good to, again, if you have no Roth money in your early retirement, considering Roth conversions, why it's good to have a blend of the two is, again, you still, even if you still want flexibility. You want to be able to say, hey, I need some more money from my investment accounts because whatever, I'm taking a trip.
Yeah.
But maybe you don't want to go into that next tax bracket that's going to have a downstream effect on things like Social Security taxability, your Medicare premiums, right? The IRMA surcharges for those. So there's a lot of downstream effects there that you want to be mindful of. And that's why having that flexibility is important.
And that's why people need to talk to you, obviously, TJ, because it's a lot of stuff. There's a lot of stuff to think about.
For sure. Yeah, no, absolutely. And, I think a lot of the retirees today, the majority of their retirement assets are in tax deferred accounts because if you don't realize, but Roth contribution availability really only came around the last like 30 years, right?
Yeah.
So,
Yeah.
yeah.
Cool. So what kind of things? Okay. So yeah, we're getting to the end of our time together. So what is it that you wish I would have asked you that I haven't asked you? What do you want people to come away with? What do you want to make sure they understand?
Yeah, I would say the biggest thing is that, financial literacy is huge. I think that, and obviously if they're listening to your podcast, they are probably more financially literate than most, but, it's really on us to educate ourselves and nobody's going to come save us, unfortunately. The government, I don't think is going to save us. I mean, obviously there's some backstops with Social Security and Medicare, things like that, but it's really on us to, in this inflationary environment, the way that you know the value of our money it seems to be losing value, and I don't know if that's going to go away. You just have to constantly understand your cash flow, automate as much as possible, and transfer the income that you're earning into assets and just get comfortable with that. And then I think for the younger people is really educating yourself on what it looks like to be a long-term investor. I think a lot of, millennials in particular feel like they're so behind that they have to take these massive risks, whether it's buying individual stocks like these meme stocks or cryptocurrency, and they don't understand the power of compound interest. They don't understand that if they just live below their means, it takes time. It's going to take a couple decades. And I think that's the thing that people, they want it.
Decades.
Yeah, they they want it right now, but that would be my biggest message is just really educate yourself on what that looks like and just start taking those small steps and habits. Focus on increasing your income. If you can, get skin in the game from your employer in the form of equity compensation. So having a salary component, but also having some stock compensation that gives you that upside. And
Yeah.
that's where I see for young people, they're actually going to have some kind of windfall event. So those would be my messages.
Excellent. Excellent. Thank you so much for being with us today. I like where we went here. I hope it was okay that I, kind of talked about some weird stuff, but
Oh, anything is I'm an open book. It was a great conversation.
awesome. Awesome. And thank you, listener, for listening. I bet that you want to know how you can reach out to TJ if you want to like start thinking about retiring, start thinking about like, even if you're like, especially if you're like 22 years old, you should be talking to TJ because everything's going to be so much easier for you. TJ, how can people reach you if they want to have a further conversation?
Yeah, super easy. Modernwealthbuilders.com. You can learn everything there. Podcast is there. It's Do More with Your Money as well. You can listen wherever you stream. Those are the two best places.
Awesome. Awesome. So check that out. That will all be in the show notes as well. And forward this to anyone you can think of. All right, let's be more specific. Write down right now 5 people who you know who would like to retire earlier than like 104 and have them and for this episode to them. They will thank you very much. And I thank you very much for being here, and we'll see you next week.
Thank you.